Hey, good afternoon, everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Here to give you a strategic approach that, boy, I bet Bill Ackman wished he did when he was in Valiant. We're talking about the cover call. All right, it's a very straightforward type of strategy, but one that is extremely powerful as far as being able to reduce your cost basis of your long stock. So, before we get into an idea, just as an example, we want to get the setup and basically the context of what a cover call is. So if you own stock and you offer someone the right to buy stock for a specific period of time, and for that right that you're giving up, you receive a credit, or in other words, some premium from the call that you sold. That's referred to as a cover call. What do I mean? That means that if you own 100 shares of stock, you can sell a call. You'll receive a credit for that, which will reduce your original cost basis or purchase price of the stock, and that's referred to as a cover call. So, what is your market outlook when you're doing cover call? Neutral to slightly bullish. Not super bullish, not mildly bullish. It's slightly bullish. Your risk? Well, it's limited to the purchase price of the stock. Your reward is limited to the short strike price of the option that you sold. You must own 100 shares of stock to be able to sell a call against it, because that 100 shares covers your obligation, right, for delivering the long stock to someone that bought it from you, if in fact the stock goes above that short strike price. So you can clearly see the advantage of doing a cover call. It's used to reduce cost basis and to also add excess yield, as well as make it a lower beta, or your standard deviation is lower as far as risk is concerned, because you're mitigating some of the cost incorporated in buying stock outright. So now I could do one in Valiant, VRX, which has gone from 200 in August of 2015 all the way down to 10. And that's what I was referring to as far as Bill Ackman. He could have been writing calls for the last 20 months. Now, yes, does that cover some of the losses that he has? Yes. Will it cover all? No. But at least it would have reduced his cost basis so that he just wouldn't have ridden this thing down to $10. So we're going to pick out a stock. I just picked it out. It's in a sector that we talked about in other tech talks, and that is in the regional banking area, and it's called KeyCorp. KeyCorp is one that we've talked about in Tech Talk because it's had earnings. It's a regional bank, and regional banks have been a topic of discussion, especially with potentially new regulations in the banking and financial sector, as well as any growth that's going to be occurring here domestically. Regional banks could potentially be catalyzed to the upside. Now you can currently see that Key is down about 14 cents today, trading at $18.39. Technically it has broken its 20 and now is holding at its 50-day moving average. But seeing that this has been in a consolidation, this might be a good covered call candidate, especially if you believe that over the next 45 days, KeyCorp could have some upside, right? Movement to the upside. Now you could compare it to the KRE, which is the regional banking ETF, and you can see that basically it has been tracking the KRE. And the KRE has been in a relatively bullish push after the election, and now consolidation, push. So the bulls have control, have lost short-term control, but it's holding right here on the 50-day moving average. And last time we saw that it basically went and tested the 50-day moving average. Well, we see that we have earnings here, and this is the last time they had earnings. They stayed in a consolidation. And then you see that they tested the 50-day moving average here, and they're testing it again today, slightly above. So we're going to watch that very closely. So I have slight bullish sentiment on this particular stock, KeyCorp. All right, and it has been tracking its sector ETF, KRE, pretty closely. And KRE is relatively bullish as well, or at least slightly bullish to neutral. as you can see here. So how do we set up the cover call? Well, we go in here, we go to key, and we're going to go to covered call. We're going to scroll down, and I'm going to look at an option that's going to be expiring in roughly around 45 days. So that's going to be the April expiration cycle. You can see here, April 21st is the expiration date of 2017. I scroll down, and I'm actually going to look for roughly the 30 delta call option in April. So if I look at the delta column here and I scroll down, I could see that the $19 calls, right, have a 38 delta, and the combined price when I buy the stock and sell the calls, and I'm selling the calls for roughly around 35 cents, my cost basis is going to be around $18. Okay, so if I scroll up here and I take a look, I'm going to be buying stock, 100 shares. Right? If I have 100 shares, I have to buy stock at $18.41. So that means that I have to put $1,841 to buy the 100 shares of stock. Now, of course, if you have a margin account, then you have to have roughly around $920 to meet the margin requirement. Now, I'm going to sell the $19 calls, and I'm going to collect 35 cents. So that means that my actual cost basis is not $18.41, which is what the prevailing market is. It's going to be $18.05. Now I could put it in for $18.10. It's currently the bid ask on the cover call is $18.01 bid at $18.06. Let's just put it in at $18.06. We're going to do it day order only. Now, as I load up this trade, some of the components, I apologize. What is your return? And have to log back in, folks. So what would be your return if, in fact, the stock goes to, let's say, $19? Your return would be the appreciation from $18.40 to $19, which is roughly 60 cents, well, exactly 60 cents, plus the premium you received, which would be 35 cents. So that would be 95 cents, or in other words, you'd have a roughly a 5.2% return if the stock goes to 19. Now, what's the probability that it could go to 19? Well, that's roughly around 30%. Exactly about 32%. And what is the probability that it could potentially touch that area? That's roughly around 68%. Now, to figure out the probability of touch, in other words, the probability of touching 90 or 19, you take the current delta and just double it. And it's basically right around 68, 70%. Okay? And I'm just going to scroll down and set this up again. I apologize. I got logged out real quick. I'm going to go down to the 20 strike or 19 strike. I'm going to buy 100 shares. So if the stock goes to 19, all in all, that's where I will cap off my profits, right? That's where I am giving up any future profits above 19. The probability of it actually being above that price is only about 35% between now and April expiration. The probability of it touching that level is roughly 68 to 70% between now and expiration. Okay, that will change as the stock changes. Now, what's the probability that it could potentially settle at 18? Well, right now it's about a 45% probability that it could touch, and right around an 82% probability that it'll settle below that, and about an 80 to 82%, 78 to 82% probability that it could potentially touch that area. So the market is basically telling me that it looks like that Key Corp could actually be, and I normally would never put this in as a market order, but I'm just for sake of getting it filled. I paid $18.05 for this. So you can, and let's say that the market doesn't do anything, that the market just sits here at $18.40 until April expiration. You would make 1.95% on your $1,800 risk. Okay? So you're really seeing how if you can, on a monthly basis, write premium against your long stock, having at least 100 shares, you're going to be able to quantify some nice yield, right? This is an excess yield outside of its dividends and anything else. One notable thing about Key that I have to also look for, it has earnings on the 20th. And that happens within the April expiration cycle. So I do have a binary event that could move stock either up or down. Now, specifically, you might ask, well, how do I know how much up or down? Well, if you go to the options screen, you put in Key, I can actually give you with a 50% probability. I'm going to do create my own. I'm going to do display Greeks. And I am going to go down and I'm just going to look at the straddle strangle market. So the stock is basically trading at $18.35. So if I buy this straddle, which is the $18 calls and puts, then the strangle, which is the first strike out puts and the first strike out of the money calls, if you scroll up, you'll basically see, you'll add up all the offers. So 91.48, so that's $1.39, $1.59, basically $2 is the total premium for the straddle strangle. Divide that by 2. So right now, Key Corp is pricing in, the options are pricing in between now and April expiration that it could move $1 either up or down with a 50% probability. Now you are basically saying, well, if I sell the $19 calls for 35 cents, I stop making money at $19.35. The strike price plus the premium tells you how much you could potentially make. Well, the stock right now, the options are only pricing in $1 move in the stock between now and April expiration, and it's currently trading at $18.40. So they're basically saying that there's only about a 16% probability that it's going to go above $18.40 between now and expiration. But of course, and it also is pricing in that it could be about roughly around $17.40 between now and April expiration to the downside. We do have a binary event, folks, that is earnings that could move the stock, but knowing this, what the estimated move is, knowing the amount of premium we just received, especially if it drops down to $17.40, I'm not losing $1, I'm only losing 65 cents. So I now have or 70 cents. So I have offset my purchase price by the amount that I sold those calls for. Hey, if Bill Ackman was doing that every month or every 20 days, 20 to 45 days, he could have offset his loss over the last 20 months by as much as maybe even half, if not more, depending upon where he was selling those calls and how frequently he was rolling them. So you could see how this is advantageous when you are looking to reduce your cost basis. All right, folks, that's it right now from MarketStream.live and Strategy Now. Join me at 3:30 Eastern Time for Tech Talk. I'm going to go over some interesting names that might have some volatility come up, especially with the FOMC coming out tomorrow. We'll see you then.